Hey, what's up, my friends? So in today's training, you will learn the 3 golden rules, right, that you can't ignore when it comes to reversal trading. So rule number 1 is this: don't stand on a rocket ship. What do I mean by this, right? So let's say the market is heading up higher in an uptrend, and now the price is kind of like in the middle of nowhere, right? So it's like kind of like a rocket ship, propelling up higher. And imagine this, right? You are standing on top of a rocket ship. Do you think that your weight will cause the rocket ship to, reverse down lower? Probably not, right? The rocket ship will shoot you up to space, and you run out of oxygen, and you're dead, right? So don't stand on top of a rocket ship, because what is likely to happen is that the rocket ship is likely to continue up higher. So likewise, right, when you see the price heading down lower in this manner, like this, don't try to catch a falling knife. Don't try to buy at this price point, because what's likely to happen is the market is likely to continue down lower. So that's why they have the saying, don't catch a falling knife, because if you do so, likely, you will cut your hand, you bleed to death, dead again. So what should you do in this instance? So this brings me to rule number 2. Lean against price structure. If you want to trade reversals in the market, lean against price structure. So how do you lean against price structure? So for example, let's say the market is in an uptrend, right? We said don't sell, right, when the price is kind of like, heading into space in the middle of nowhere. Instead, let the price make a pullback first. Because as you know, right, no market goes up in one straight line. It makes a pullback, continues up higher, pulls back, continues up higher. So wait for the pullback to come. When the pullback comes and the market now approaches the highs once again, there are 2 things that could happen. Number 1, the price just simply breaks out of the high and it continues higher. And if that happens, right, you stay on the sidelines, you don't short the market, you don't risk a single cent. Number 2, what could happen is that the market approaches the highs and then quickly got rejected like this. Maybe looking something like a shooting star pattern like this. Now at this point, right, when this happens, let me just redraw that because it's a bit messy. Okay, so let me just do it again. So the price retests the highs, and now you have like a shooting star pattern like this. At this point, you have a bearish price rejection. Maybe because the buyers saw that the price is approaching the highs, they look to take profits. That causes some selling pressure in the market. Maybe the short sellers seeing the price, failing the highs, looking to short the markets. Whatever the case is, you can see that there is selling pressure in this market. There is bearish price rejection. Now, this time around, if you were to short the market, now you have a price structure that you can lean against. You can now actually lean against these highs or this high of this week, right, to set your stop loss. So let's say you short at the next candle open, you can set your stop loss, right, a distance above this high, somewhere about here. Can you see the difference now? Now you're referencing a point, right, a logical point on the chart, right, where selling pressure has shown to appear, and you can use that to set your stop loss. Now, one of 2 things can happen. Number 1, you are wrong and the market continues up higher. Fair enough, you cut your loss and you move on. At least you set your stop at a logical place, right, where the market should have difficulty reaching. Or number 2, you time the market correctly and the market starts to reverse down lower. Okay, and this brings me to my 3rd golden rule, right? Don't be greedy. And by the way, if you're enjoying this video, smash the thumbs up button. If not, hit subscribe. So now what do I mean by don't be greedy? So often, right, a mistake many traders make, right, is that, let's say for example, let's use the downtrend for example, right? Market bounce up, comes down lower, form a bullish hammer, and they buy, right? Then the market hits up higher. And they're celebrating, whoo, right? I managed to catch the bottom, right? It's time to ride the new uptrend up higher. So they think the market, will continue up higher, right? And they can, get a massive favorable risk to reward on the trade, risking $1, make $20 and stuff like that. But that's kind of like fantasy. The reality is what's going to happen is that this is likely to happen. Okay, let's say the market is at the bottom. You manage to catch the bottom for whatever reason. Maybe there's a nice bullish price rejection. Market continues up higher, right? And at this point, right, you want to consider taking profits. Don't be greedy, because what's likely to happen is that the pullback is likely to end, and then the downtrend resumes itself. So don't be greedy, right? As a reversal trader, you're not trying to capture the new start of the trend from head to tail. You're just simply trying to capture that one move, that one swing in the market before the long-term trend continues, right, in the same direction. And you want to get out, right, before that happens. So these are my 3 golden rules when it comes to reversal trading. Number 1, don't stand on a rocket ship, don't catch a falling knife. Number 2, lean against price structure so you can set a logical stop loss. And number 3, don't be greedy. And if you want to learn more, right, grab a copy of this book here called Price Action Trading Secrets, right? I'll share with you practical price action trading strategies and techniques, right, that you can use to trade the forex, stocks, and even crypto markets. I'll put the link somewhere below this video. You can grab a copy, right? And with that said, I wish you good luck, good trading. Talk to you soon.